Welcome to the show. I'm Andy Hagens, and today we're talking with Howard Crosby, Chairman and CEO at LGX Energy Corp. Howard, welcome to the show.
Thanks, Andy. Good morning, and glad to be here. It's exciting to chat with you this morning.
And I know you have a wealth of experience in the oil and gas industry, a ton of knowledge. I just want to dive right in, really to your backstory, your career, your previous company, and then we're going to get to your current company. So we're going to talk about the energy industry, but let's talk about your previous success story, which was Cadence Resources. I believe you founded that in 2001. Is that right?
That's right. My partner, John Ryan, and I founded Cadence Resources in 2001. We actually took an old publicly traded shell company that was called Royal Silver Mines that we had control of, and we converted it to Cadence Resources and put it in the oil and gas business in the February or March of 2001. Went down to Houston and we met a really interesting, crusty old geologist by the name of Lucius Gear, who was in his 70s and had been chief geologist for Unocal. And he got us involved. I had been an investor in oil and gas for many years before that, of course, and had been involved with a couple of other projects. But this was really my first major role in it. And we got involved in some projects up in North Texas that Lucius put us on to up in Wilbarger County. Got some early production going, and we kind of hit the oil cycle pretty good. We ultimately expanded over into a deep gas project in DeSoto Parish, Louisiana, over south of Shreveport. But I remember, Andy, in May of 2003, the oil price had moved from about the low 20s to about $32 a barrel. And most of the major analysts on Wall Street, including, Bear Stearns and Lehman Brothers and Goldman Sachs and everybody, were calling for the oil price to drop back into the low 20s. Mm. And as an independent oil company executive, I was invited by Anthony Mason to appear on the CBS Evening News to discuss the oil price and how it affected small companies. And I said, well, at the time, I said, Anthony, I actually think the oil price is probably going to move higher from here, and it wouldn't surprise me to see oil hit $50 a barrel by the end of this year. And that was in May of 2003, and sure enough, by Christmas, it was over 50, which apparently made me somewhat of a prognosticator. So a year later, Anthony Mason had me back on the CBS Evening News to say, you were the only one that called this. What do you think now? And I said, well, Anthony, I think we could be range bound for a while, probably between 50 and 65 or 70. But when it does break out, I think it'll probably break out to the upside. And sure enough, 3 years later, oil went over $100 a barrel. He never had me back again, though. So apparently my days as a prognosticator for CBS News were over. But maybe it took too long for my feelings to come true. But it was a good run with Cadence. We took the stock from a market cap of under $1 million in the spring of 2001, and when we uplisted to the American Stock Exchange 5 years later, it had a market cap of over 400 million. And we merged with a company called Aurora Oil and Gas, and I stepped away from management then in the spring of 2006.
Got it. Okay, so we want to talk about your current venture, but what I think is interesting is, a lot of what I cover on my other podcast is real estate. And I always like to pick people's brains on previous cycles, right? Because like a GP or a manager who's been around for a while, they've seen the peak and the trough and that complete market cycle multiple times, that there are patterns that they recognize, but also each cycle is a little bit different, right? I mean, even the last couple of years in the United States with our economy, I don't think anybody predicted precisely what was going to happen. What I'm curious, you were an energy bull or an oil bull in the early 2000s, and again, I presume you're bullish on oil in 2023. What is similar in terms of the context right now, and what, if anything, is different this time around?
Well, there are similarities in the cycles. I don't think anybody predicted that a few years ago oil was going to go to negative $35 a barrel. Mm-hmm. That I don't think anybody saw coming. But there's issues with oversupply, and it's supply and demand is always a factor. Um, I was a believer back in the early part of the new century in Hubbard's Peak, but I don't know if you're familiar with that. But it was work that was done by a shell geologist back in the 1950s, and his name was King Hubbard, and he predicted that the oil production in the United States would peak in January of 1972 at 9.2 million barrels a day and would begin a long, inexorable decline and would never again reach that peak. And this was based on the work that he did with the discovery and the decline of supergiant oil fields. Mm-hmm. And it turned out that King Hubbard, even though he made this prediction in the late 50s, was exactly right. He hit the peak within 2 weeks, and our production continued to decline from 1972 all the way into the first few years of the new century. What King Hubbard didn't factor in, and what I didn't understand in the years with Cadence Resources, was the impact of technology, particularly the impact of fracking.
Right.
And fracking is what allowed us to tap previously undevelopable, if that's a word. I don't know if undevelopable is a word. It's certainly a mouthful.
Inaccessible.
Inaccessible, yes. Yeah. Resources that were in tight structures, sure. Tight formations that didn't have a lot of natural porosity or permeability. Things like the Bakken Formation in North Dakota, which may host as much oil as the entire Middle East, but it's in a tight formation that has to be heavily broken up with frac sand in order to produce it. And once that happened, that revolution of fracking that opened up these tight formations across different provinces in the United States, our production rapidly climbed and surpassed the 1972 peak. Once again, the United States became a major producer of oil. In fact, even became, as you know, an exporter of oil briefly in the years leading up to the last election.
Right.
So this put a lot of the fact that the U.S. was no longer a major importer of oil and was in fact a major producer once again led to an oversupply. It led to the fact that a lot of the other major oil exporters in the Middle East and Russia were under a lot of economic pressure with declining oil prices. And so they tried to counter that by upping their production, sell more oil at a lower price and still sell as much, right? Mm-hmm. And that put downward pressure, which ultimately drove the oil price to low levels that nobody anticipated. But it was pretty clear to me that with the change in the administration in this country, as well as some of the policies that were occurring overseas, and then particularly when the Ukraine war broke out and we had we were going to embargo Russian oil, that with our own slowdown in production, that we were going to be headed for a much higher price regime going forward. And I think that where a lot of people miss it is that, oil is the largest commodity in the world. It's a $2.1 trillion annual market. That's as of last year. And that's more than double, for instance, the size of all the metal markets combined. So if you take iron ore and gold and copper and nickel and zinc and whatever, add them all together, they're less than half the size of the oil market. And oil is used in over 6,000 products that we use every day. So regardless of the attempts to mitigate away from using oil as the primary transportation fuel, so-called electrification of the transportation fleet that is being attempted, the growth in oil demand from other parts of the world continues to grow, and the transportation revolution, if you will, in my opinion, is not going to materialize the way that people predict it will, for a lot of reasons that we could go into.
Well, let's go into that a little bit. So I understand, I understand the concept that even if, a huge portion of citizens in developed countries switch to EVs in the next generation or two, it's going to be less demand for oil just for pure transportation, but we're still going to be using all of these oil derivatives in manufacturing, right? So there's that aspect of it. But you also don't think that the transportation revolution will occur sort of as is being predicted
Well,
right now?
no. Well, first of all, I mean, you're already seeing that, like, for instance, Ford Motor Company is going to lose $4 billion this year in its EV division. Um, and there's already moves afoot to move away from some of the transition. For instance, there's a I don't know if you read the story about the battery plant that Panasonic's building in Kansas.
No, I
The
haven't.
Yeah, it's a huge battery plant for EVs, and I think they got something like an $8 billion subsidy from the federal government to build this giant battery plant in Kansas. Well, the problem was that that battery plant is going to require so much electricity that Kansas, they've had to restart a giant coal-fired power plant just to provide the power for the battery plant to build the batteries for EVs that are supposedly going to happen in the future. But if you look at the overall supply chain for batteries, let's just talk about that aspect of EVs. Certainly we don't produce very much lithium in this country.
Right.
There are worldwide sources of lithium that are fairly available. We produce zero cobalt in this country. All of the cobalt comes from either Russia or the Congo. I very much doubt if your average Tesla owner realizes that he's supporting child labor in the Congo, where 60% of the world's cobalt comes from.
Right.
And these kids are working in appalling conditions with extremely high fatality rates. Nickel is also in short supply, but ultimately the thing that will be the showstopper for the whole electrification business is there is simply no way that the world can produce enough copper to provide for what the forecasts are indicating is going to happen.
Hmm.
Copper is the key to all electrification, both for electric vehicles, which use 2 to 3 times as much copper as a conventional internal combustion engine vehicle, as well as all the copper that would be required for all the infrastructure and the charging stations and all the other applications for electrification that require massive amounts of copper. And if you look at the copper production and the forecast, Chile is the world's largest producer of copper. They produce, like, I think 5.4 million metric tons of copper per year. They're by far the largest. The biggest copper mines in the world are mines like Chuquicamata and Escondida in Chile or El Teniente, and they're all very, very long in the tooth. They've already lowered the cutoff grades and doing everything they can to continue to produce as much as possible. But there's a lot of forecasts out there now that are calling for, big time forecasts from Bank of America and Goldman Sachs that are saying the copper price could go from $8,100 a ton to $15,000 a ton within the next 24 months. And even that won't chase out enough copper to make these EV dreams come true.
Well, speaking as an oil and gas investor, it almost sounds like you could hedge your bet by investing in copper alongside oil and gas.
Well, and in fact, I have done exactly that. Yeah. I've got a major stake in some copper investments. But as far as the future of oil is concerned, the poorer countries, if you will, the emerging countries, the third world countries in Africa and Asia and elsewhere, are totally dependent upon fossil fuels for improvement in their lifestyle and their economies. They have no choice but to go to fossil fuels. And even countries in Europe now are having to turn away from some of the green energy solutions that they were advocating. Germany is now restarting coal-fired power plants because the solar farms and the windmills just don't make the cut. I mean, they're not stable sources of power. They're not firm power. I used to live, before I moved here to California, I used to live in Walla Walla County in southeastern Washington. Mm-hmm. And I'm getting a little far afield from oil and gas here, Andy, but the largest wind farm in the country at that time, this is a few years ago, was in Walla Walla County. And it was owned by Florida Power and Light. Now, if you look at a map of the U.S., Walla Walla County in southeastern Washington state is quite a long distance away from Florida, like one end of the country to the other, right?
Yeah, sure.
So I had lunch with the project manager a few years ago after it got up and running. They invested about $800 million in building this 600 megawatt wind farm. And I said, how's the wind project going? Yeah, it's okay, he said. I said, well, that's not exactly a ringing endorsement. Well, we have some problems. I said, such as? Well, of course, they take a lot of maintenance and they kill a lot of birds. The windmills chop up a lot of birds. But he said the biggest problem is that as a utility, we're required to deliver power to our customers at peak load.
Mm-hmm.
And that typically, when that happens, the wind isn't blowing. So we have to keep a power plant on standby to kick in to provide power at peak load. And I said, well, you're smart guys. You knew all of that ahead of time. He said, oh yeah, we knew that. We knew all that. I said, well, then why this $700-800 million investment? Well, he said, we needed the green credits. I said, the green credits? He said, yeah, by building that giant wind farm, we got enough green credits that we were able to build a 1,500 megawatt coal-fired power plant in Ocala, Florida. So the $700 or $800 million that they spent on the wind farm was simply part of the sunk cost of building the coal plant that they needed.
Well, and to your point, I think it's a little bit of common sense. So many of these forms of renewable energy are not economically viable without huge government subsidies, right? That's the only possible way they become. And then sometimes even then, they might be economically viable to build, right? But then the subsidies maybe don't last indefinitely. And so they're not even viable to operate. And, it depends, right? Not every form of renewable energy is the same. There are some use cases that are more viable than others, but I think that's on a large scale. Would you say that that's fair?
Oh, that's totally fair. And not only that, my brother-in-law passed away last year at almost the age of 90. He was a former assistant secretary of energy, and he wrote numerous books on the energy business. But he always made a point that other than nuclear, no other form of energy has to build in the life cycle cost of the energy that's being produced. And this is really coming home to roost for the Germans right now with all their windmills, because they've reached the end of the life. And what do you do with these giant windmills when you have to decommission them? These blades they have to be buried. They're not recyclable. They're monstrous costs in decommissioning these windmills.
Yeah, it's almost like nuclear or something when you have to plan decades ahead. So, okay,
and they haven't. That's the thing. But there's so many things.
Well, Howard, to follow up on that though, I mean, I'm gathering you're very bullish on oil, which I understand. I think
for sure.
You've laid out that case. I've laid out that case. Are you bearish on renewables? I mean, how do you think this shakes out 10 or 20 years from now? Do Western governments kind of re-up the subsidies? Do they continue to gain ground, or do you think that there's kind of a reset going on where some of the owners of these projects or financiers of these projects or even governments are sort of taking stock and saying, what, maybe some of these renewable projects were not a good idea? Do you think that's going to happen? Do you think there's going to be any sort of
I think it's already starting to happen. Sweden has recommitted to building nuclear power plants.
Okay.
They were an early player in the windmill fantasies, and so forth, and it's happening elsewhere as well. But no, I mean there's a place for renewables. I mean, my brother-in-law always made the case that it's an all of the above solution. I mean, certainly use renewables where they work. I mean, where I live here in Southern California, where the sun shines all the time, passive solar works great.
Right.
You put solar panels on your roof and you cut your electricity bills by 80-90%. It's great. Doesn't work so well in Seattle, where it's cloudy all the time and rains most of the time. Yeah, solar isn't too effective there. Right. So, you use it where it makes sense, I think is fine. I think where I come down is there are some things that the average person doesn't realize about the oil and gas industry. For instance, this is one of my favorite statistics. In about the year 1900, about 94% of the U.S. workforce was involved in subsistence farming. Okay. And today, the number of people farming is less than 2% of the workforce. And yet that 2% provides vastly more output of agricultural products than the 94% did 125 years ago.
Right.
Why is that? Two reasons. One, fossil fuels, oil that fuels the farm machinery, the giant combines and tractors and things that make for much more efficient processing of the land. Even more important, probably, natural gas, because it's natural gas-based fertilizers that gives us a chance to feed the world's 8 billion people. Without natural gas-based fertilizers, there would be mass starvation worldwide.
So do you think that that is just that fact, right? The fact that natural gas is essentially responsible for feeding
The
humanity
planet.
on a mass scale. What percentage of, the population or the media or policymakers, how many people really know that are aware of that fact?
I don't know, 2% maybe?
Maybe. And
Yeah.
and so, I mean, that's really what concerns me is not so much the point of view that it's promoting renewable energy, clean energy, but rather making these decisions lacking the context of the trade-offs involved and really the uses of all forms of energy, right? Like as you pointed out, solar
Exactly.
solar working beautifully in Florida, right? That passive form of
Mm-hmm.
energy being very efficient there. But all of these different forms of energy have, their best use, their most efficient use, and in some cases they
They,
truly
and,
are irreplaceable, right?
and they all have environmental costs. It's not like that electric vehicle that you're driving is a zero emission, zero environmental cost situation. And I like to use this analogy on that, Andy. So when I drive my car and I fill the gas tank up, if I don't put gas in that gas tank, that car's not going anywhere. The battery in your EV is exactly the same as my gas tank. You don't
Right.
put charge in it from energy generated somewhere else. The battery itself provides no energy at all. It's simply it's a gas tank. That's all it is.
It
The
stores
difference
energy.
is, yeah, it stores energy generated somewhere else,
Mhm.
right? So the difference is when I turn my car into the junkyard and they melt it down, there's nothing particularly toxic about my empty gas tank. When you try to dispose of those lithium battery packs in a EV, it's a massively dirty, environmentally disastrous situation.
Yeah, and I think that that's another kind of I don't want to say dark side, another another con
Sure.
to EVs. And I want to be clear to listeners, to the audience. For me as a host, and I think for most guests on this show, it's not a matter of being pro anything or anti anything. It is simply a realistic assessment of the trade-offs involved. That's what I really don't like is when policymakers or really anyone in the media are not honest about trade-offs, right? They'll paint a very simple picture of the environmental consequences of one form of energy, not being aware that there are trade-offs when you switch to another form of energy that may also impact the environment, right? And as you pointed out, the environmental trade-offs of using batteries in EVs. Also, you talked about the human rights issues with the supply chain for EVs.
Right.
And again, it's a trade-off, right? You could still be in
Well, sure.
favor
And
of
look, I mean, I don't have any problem. Somebody wants to drive an electric car, it's fine with me. It doesn't bother me. But you have to understand that there are trade-offs. And something my late brother-in-law pointed out to me a few years ago. He said, I think in 39 of the 50 states, if you're driving an electric vehicle, you're probably causing more airborne CO2 emission than if you were driving an efficient Toyota engine, because the energy that was used to charge your battery probably came from a coal-fired power plant or other source that actually produced more CO2 output than the efficient gas engine does.
right, right. Okay, well, you know what, Howard, I love this kind of big picture talk. We're solving the world's problems, but I want to bring this out to your
Sure.
current
Yeah.
company, right?
Well.
Because you're an oil
Yeah.
and gas bull. So take us to
Yeah. So
LGX Energy. When
yes.
did
Well.
when did you start it, and how does it
So
work?
So we formed the company in November of 2021, and in January of 2022, we acquired a company called Adler Energy, which had a small producing field in Clay County, Indiana. And they also had about 400 miles of 2D seismic that they had shot over a 4-county region 15 years earlier and never processed it. So when we acquired Adler, we bought 6 or 7 producing wells, which are still producing. And we also got all this seismic. And with that seismic, we started processing it. I put together a team with over 150 years of industry experience. And lo and behold, we found that in this particular part of the Illinois Basin, which is, one of the most prolific basins in U.S. history, there were an awful lot of high-quality prospects that had never been found because nobody had ever applied modern science to the area. So just in the first full year of processing about a quarter of that seismic, we've identified over 55 drillable prospects that look really interesting. We've reconfirmed some of that with 3D seismic. We're engaged right now in a Reg A plus offering to raise drilling money, and we're continuing to produce oil. We're very excited about working in the state of Indiana for a lot of reasons. Most people don't realize that the first 100 million barrel field in U.S. history was a Trenton field discovered in eastern Indiana in Allen County by John D. Rockefeller. And that 100 million barrel field was the basis of his entire fortune. That's how he got started. There's been billions of barrels of oil and trillions of cubic feet of natural gas that have been produced in the Illinois Basin. And the particular area that we are in has been very lightly explored. Almost all of the production historically has come from mom and pop operators at very shallow formations like the Carper Sand or maybe the Salem Limestone. And most of these deeper horizons, even some of the shallower reefs, have never been found because they've never been looked at using modern seismic. And so we're just super excited about where we are. We're able to get leases at attractive rates. We're only having to pay 12.5% royalties versus much, much higher royalties and much higher lease bonus costs, for instance, in the Permian Basin. State of Indiana is a great place to work. The business climate is favorable. We can get a drilling permit in a week to 10 days. So, all the stars have kind of lined up for us. We're very, very excited about what we're doing there, and we think the future is very bright for production in this part of Indiana.
So what is for LGX or for an investor, for an LP, what is the life cycle then of an investment look like? So you're raising capital from private investors and other investors. You put that to work with exploration. How long do you expect to be exploring and bringing wells online versus then becoming sort of a more cash flow enterprise?
Well, I think we're cash flowing some right now, and the cash flow is going to build very, very rapidly because the cost of drilling these wells, I mean, we're drilling straight vertical wells, so these are not complicated horizontal structures. They're not expensive to drill. We can drill and complete a reef well in Clay County, Indiana for $325,000 versus millions of dollars in some of the other parts of the country. So payback is typically less than 6 months, or maybe 8 months at the outside, depending on the IP rates. These wells will produce for 40 years with a traditional kind of decline. So we get a flush production that pays the well out fairly quickly. And then, a year and a half later, it's producing 40% of what the IP rate was, but it'll continue to produce for decades, actually. Right. So it's a very favorable scenario. It's all high quality oil, light sweet crude, high API, and all the infrastructure in the Illinois Basin is readily available. Drilling companies, workover rigs, jobbers, and there's refineries nearby. We're selling our current production to the Country Mark refinery just up the road in Western Indiana. So it just ticks all the boxes for us. No federal land. We're leasing all from private enterprise, private landowners.
Got it. Okay. So your statement that the stars are aligning for you. It sounds like this is I don't want to say a dream project, but it sounds like a lot of positive aspects to this portfolio you're building. We're almost out of time, but one question I have. So you obviously have an investment offering. You have this promising project. To your point, already cash flowing, multiple wells. How is the fundraising environment, right? Because on the institutional side, we've seen a lot of institutional investors have pulled back, but I've also noticed on the kind of on the ground level, with private money, there's a lot of excitement around oil and gas right now. So,
I think that's right. Yeah, I think if anybody wants to learn more about us, we've got a lot of information on our website, which is lgxenergycorp.com. So LGX Energy Corp. There's a lot of information there. You can see how to attend one of our webinars to learn about the Reg A offering that we're doing, and we're getting a lot of interest in it, I believe, Andy, and I think we'll continue to get more because I think people have to understand, or they will understand that oil deserves to be a part of everybody's investment portfolio. And we've tried to structure the offering in a way that I think will be appealing to investors, and certainly will be appealing to people that understand oil.
When you're speaking with a private investor about oil and gas, your point, it deserves to be a part of every investor's portfolio. I'm curious, what aspects are you stressing the most? Are you stressing, upside potential, income, tax benefits, all of the above? What resonates with investors? What resonates with you?
Well, we've structured our offering as a convertible preferred with a dividend that's being paid. So there's current income with upside, convertible into the common stock. I think what should resonate with investors, particularly if they look at our project in Indiana, is we're not, because of the nature of what we're doing and the margins that are available to us, we're not particularly susceptible to wild spring swings in the oil price. I mean, yes, we love $85 oil. Our lifting cost is under $10 a barrel. Our finding cost is low. So I think, we can make a lot of money at much lower oil prices than we currently have. Not that we expect that. I mean, yes, could oil drop back again into the $60 range? Sure. There's short-term fluctuations in supply and demand that are always possible. But longer term, we're very bullish on the oil price and on the future of the world's going to look. Oil's the most important commodity in the world. There's nothing else even close, and it will continue to be the most important commodity for the lifetime of anybody that might be listening to this, including infants that might be listening to this.
I think those are good words to end on, Howard. Yeah, I appreciate your, just talk of this overall macro environment globally with energy, as well as giving us more insights about LGX Energy. And one more time, where can our audience go to learn more about your investment offering?
Sure. Just take a look at our website, which is lgxenergycorp.com. Andy, it's been a pleasure talking with you today.
Thanks so much for joining the show today.
Happy to talk energy anytime.